Hello students, welcome to Accounting 2402. This is Principles of Managerial Accounting. My name is Mrs. Mercado, and this is going to be a short lecture over some of the problems that you're going to be seeing on your homework for Chapter 20, which deals with cost, volume, profit analysis. It's very important that before you attempt your assignment, you read the chapter. Okay, so there's a variety of resources available for you. The first thing is, remember, we have to read the chapter. PowerPoints are made available in Blackboard. That way you can download them and review the information. I highly recommend that you complete the quiz before attempting your homework, as the quiz is multiple choice and it's in a simpler format and it's more terminology based. And then the last thing that you work on is your homework problems. Okay, for when you're working on your homework problems, I create this lecture to help you with some of the problems. And when you go into Cengage, a lot of these or most of these problems also have a show me how video embedded in Cengage, so you can be able to view the video and help you solve the problem, in addition to reviewing the content in the chapter. Okay, so in this particular chapter, we're going to learn about variable cost and fixed cost. So basically, variable costs are any costs that vary in proportions to changes in the level of activity. Okay, the more activity you have, the higher your variable cost. Then we have fixed costs. Basically, those costs remain the same in the total dollar amount as the level of activity changes. So these are fixed costs. It doesn't matter if you produce 100, 200, 300 units. These are fixed. So those are the two main components that we're going to be analyzing in this particular chapter. And then we have the mixed cost, which is comprised of both variable and fixed cost. The contribution margin is explained how it's calculated. Basically, the contribution margin is the excess of sales revenue over any variable cost. And then we also go over the break-even point, as to that is the point in which a business's revenues exactly equals its cost. So we have to figure out, okay, how many units do we have to produce to break even, okay, to cover all of our costs. And then anything above that point, that's going to be basically our revenue. Okay, so there's just so much information that is included in the chapter. That's why it's very important that we go over it. Okay, I'm not going to go over the content of the chapter. I'm going to dive into doing some of the problem solving for some of the problems that you're going to be seeing on your homework. Remember, I don't go through all of the problems, but if when you're working on your homework you have any questions, you have any concerns, or you're having any issues, please feel free to contact me. I am here to help you out as much as I can. Just be specific on your questions. That way I can be able to help you out and answer your question. Okay? So, in this particular lecture, I'm going to go over 3 problems. The first one is exercise 27. Okay? So, this particular exercise deals with the high-low method. Okay? So it says, Sigler Incorporated has decided to use the high-low method to estimate the total cost and the fixed and variable cost components of the total cost. The data for various levels of productions are as follows. So we have units produced and total cost. So when we produce 80,000 units, our cost is 25,100,000. When we produce 92,000 units, our total cost is 27,206,000. And when we produce 120,000 units, our total cost is $32,120,000. Okay. The first requirement is to determine the variable cost per unit and the total fixed cost. Okay. So I've set up the first requirement here. So to be able to calculate, the first component that they're wanting us to do is the variable cost per unit. Okay, the variable cost per unit. To be able to calculate our variable cost per unit, we're going to get the difference in total cost divided by the difference in units produced. And we are using the high-low method. So it's going to be the difference in total cost between the highest and the lowest. And then the difference in units produced, the highest and the lowest. So we're going to look at our total cost column here, and we're going to identify which one is my highest. Okay, my highest cost. Well, my highest cost is the 32,120,000. Okay, 32,120,000. Okay, and I'm going to get the difference, so I'm going to subtract by the lowest amount. Okay, so my lowest cost is the 25,100,000. Okay, and I'm going to divide by the difference in units produced for my high and my low. So my number of units for my high is 120,000 units minus my low, which is 80,000 units. Okay, and let's see what we get. So we're going to get our calculator. So we have, well, I'm not even going to simplify. First, I'm going to do the top and then the bottom. That way we don't get confused. So it's 32,120,000 minus 25,100,000. That gives me 7,020,000. Okay, that's my difference in total cost between my high and my low. And then I'm going to get my difference in units. I have 120,000 minus 80,000. That gives me 40,000 units. The difference between my high and my low is 40,000 units. Okay. Now that I have that, I can go ahead and I can calculate my variable cost per unit. And my variable cost per unit will be 7,020,000 divided by 40,000 units. Okay. So my variable cost per unit is going to be $175.50. Okay. So for every unit, my variable cost associated is $175.50. Okay. So that is the first part. They're asking us to determine the variable cost per unit, $175.50. They're also asking us to calculate the total fixed cost. Okay. So my total cost is going to be equal to my variable cost per unit, which we just calculated, times the units produced. Okay. For both the high and the low method. And then we're going to add our fixed cost. Okay. Now, the fixed cost component, we don't have it. We're going to have to solve for it. Okay. So let's start the calculations for the highest level. Okay. So my variable cost per unit, we just calculated it at $175.50. Okay, $175.50. I'm going to multiply it by my units produced. And we produce for my high 120,000 units. Okay. And then I'm going to add my fixed cost. Okay. Let me move this over here because I need to, okay. So it's your total cost equals, right here. Oh, sorry. Your total cost equals your variable cost per unit times your units produced plus your fixed cost. What is my total cost? My total cost is $32,120,000. Okay, so your total cost, $32,120,000, equals your variable cost, which is $175.50, times the unit produced for my high amount plus your fixed cost. Okay, so now we are going to solve. Okay, so what is 175.50 times 120,000 units? So 175.50 times 120,000 units, that gives me 21,060,000. Okay, plus my fixed cost. So now I need to solve for my fixed cost. So what do I need to do? I need to transfer that amount over to my other side so I can solve for the fixed cost. So I'm going to have my 32,120,000 minus the 21,060,000. Okay, that is going to give you your fixed cost. So let's get our calculator. 32,120,000, 1, 2, 3, minus 21,060,000. So therefore, my fixed cost is going to be 11,060,000. all we're doing is we're solving for the component that we're missing, which is my fixed cost. We have the total cost, we have the variable cost, and we have the units produced. What we're missing is that fixed cost component. Okay, so we're going to plug in everything we have. Once we plug it in, we move this number over to my other side so I can leave my fixed cost alone on the right-hand side. And then I can calculate that my fixed cost is 11,060,000. Okay, now that is for my highest level. We're going to do the same thing now for the lowest level. So for the lowest level, let me insert a new cell here. Okay. Now for my lowest level, my total cost is 25,100,000. Okay, I'm getting it from over here. Okay, that is going to equal. Okay, and once again, we're going to do the same formula. My variable cost is 175.50. I'm going to multiply it times the number of units. The number of units for my low is 80,000. And then I'm going to add my fixed cost. Okay. So now I have to solve. Okay. So let's get our calculator out. So 175.50 times 80,000. That gives me 14,040,000 plus my fixed cost. Okay. Now I'm going to solve for the fixed cost. So I'm going to get my 25,100,000 minus my 14,040,000. And that is going to give you your fixed cost. Okay, and then we can get our calculator. 25,100,000, 1, 2, 3, minus 14,040,000. So my fixed cost is going to be 11,060,000. Okay, same thing for my high and my low. They should give you the same thing, 11,060,000. Okay, that's my fixed cost. Okay, so your fixed costs should not change. Remember, fixed costs do not change. They stay the same regardless of the number of units you produce. Those are fixed. Okay, so even though you produced, in this example, 120,000 units, and in this other example, 80,000, fixed costs remain the same. So that's why we obtained the 11,060,000 for both the high and the low. Okay, so that is requirement A. Determine the variable cost per unit. My variable cost is 175.50, and your total fixed cost, your fixed cost is 11,060,000. Now, requirement B. Based on part A, estimate the total cost for 115,000 units of production. So if we are to produce 115,000 units, what is your total cost? Okay, so we have to calculate. Remember, your total cost equals your variable cost per unit times the units produced plus your fixed cost. Okay, so let's start off with the number of units that we have, okay, or that we're going to be producing under this scenario. Okay, so the number of units are 115,000. That's how much we're anticipating producing. Okay, we're estimating 150,000 units. Okay, we have our variable cost per unit, and that we're going to multiply it by it. Okay, and my variable cost per unit is 175.50. We had calculated it up here. Okay, now we can get our total variable cost. So my total variable cost is going to be the 115,000 units times 175.50. Okay, that's going to give me 20,182,500. Okay, then I'm going to subtract my fixed cost. So my fixed cost, we calculated fixed cost to be at $11,060,000. Okay. So now we can calculate our total cost, and this includes both variable and fixed. So we're going to add those together. And that's going to give me $31,242,500. Okay. So requirement B. If we estimate a total cost for 115,000 units of production, what would that be? Excuse me. That would give you 31,242,500. Okay. And this is for 115,000 units. So you get the number of units times the variable cost to get your total variable cost, and then you add your fixed cost to get your total cost. Okay. Okay, so that is exercise 27. Okay. The next one we have is exercise 2011. Okay. So this one deals with break-even sales and sales to realize operating income. So it says for the current year ended March the 31st, Costco Company expects fixed costs of $27,600,000, a unit variable cost of $805, and a unit selling price of $1,150. A. Compute the anticipated break-even sales in units, and B. Compute the sales units required to realize operating income of $5,175,000. Okay. So let's start with letter A. It says compute the anticipated break-even sales in units. Okay. So to calculate our break-even sales in units, we're going to get our fixed cost divided by our units contribution margin. Okay. Fixed cost divided by our units contribution margin. Okay, so my unit contribution margin, that's the dollar available from each unit of sales to cover fixed costs and provide operating profits. The formula to calculate my unit contribution margin is your sales price per unit minus your variable cost per unit, and that's going to give you your contribution margin. The sales price minus the variable cost. Okay. So let's start with my fixed cost. Okay. Does the problem give us the fixed cost? Well, it says here that the company expects fixed costs of $27,600,000. Okay. So I'm going to put that there. Okay. And then I am going to divide it by my units contribution margin. And your units contribution margin is your sales price, and my sales price is $1,150. Okay, minus, okay, your variable cost per unit. Your variable cost per unit is $805. Okay, and I forgot to put. There we go. Okay, so this is what we have. Let me just put some commas. Okay. So now, my fixed cost, $27,600,000. Your units contribution margin is your sales price of $11.50 minus your variable cost of $805. Okay, so let's see what we get when we plug that into our calculator. So I know that $11.50 minus $805, that's going to give me $345. Okay, so it'll be $27,600,000 divided by 345. That's going to give me 80,000 units. Okay. So to break even in units, you have to produce 80,000 units. Okay, to break even. Letter B says, compute the sales units required to realize operating income of $5,175,000. Okay. Now, to be able to calculate the sales units required to realize operating income of 5,175,000, we're going to get our fixed cost plus our target profit divided by our units contribution margin. Okay. So let's start here. So my fixed costs are 27,600,000. Okay. I'm going to add my target profit. Your target profit is 5,175,000. Okay. And I'm going to divide by my units contribution margin. And your units contribution margin, we've already calculated here, 1150 minus 805. And your contributions margin is your sales price, 1150, minus your variable cost. Okay. Okay. So now we can enter into our calculators. 27,600,000 plus 5,175,000. Okay. Let me write that number down. That's going to be 32,775,000. Okay. And then 32 million, well, let me put the number over here. That way we can solve. Okay. Okay. So let's do it again. 27,600,000 plus 5,175,000, 32,775. Okay. So it'll be 32,775. 32,775. Okay. And I am going to divide by the 1150 minus the 805. That gives me 345. Okay. Now we can get our calculator out and divide my 32,775,000 divided by 345. That gives me 95,000 units. So in letter A, we computed the break-even sales, okay, which was 80,000. In letter B, we computed the sales required to realize operating income of 5,575,000, and the sales in units required to obtain operating income of 5,071,000 is 95,000 units. Okay. So that is the second problem you're going to be seeing on your homework, or a problem similar to this. That way you can practice. Okay. Now the last problem that we are going to be covering in this short lecture is problem 22A. And let me look for my piece of paper over here where I have highlighted your upcoming test. Let me see. Where did I leave it? Oh, here it is. I found it. Okay, so on your upcoming test, you're going to have a problem similar to this one. Problem 22A. Okay, and this problem deals with break-even sales under present and proposed conditions. Okay, so it says Portman Company operates at full capacity, sold 1,000,000 units at a price of $188 per unit during the current year. Its income statement is as follows. Okay, so they have the amount of the sales of 188 million. We have our cost of goods sold of 100,000. We have our gross profit of 88,000. Our selling expenses of 16 million. Our admin expenses of 12 million. Total expenses are 28 million, and operating income is 60 million. Okay, The division of cost between variable and fixed is as follows. Okay, so we have the variable percentage and the fixed percentage for my cost of goods sold, selling expenses, and admin expenses. Okay. Management is considering a plant expansion program for the following year that will permit an increase of 11,280,000 in yearly sales. The expansion will increase fixed costs by 5 million, but will not affect the relationship between the sales and variable costs. Okay? So we have a lot of requirements here. So the first one, determine the total variable cost and the total fixed cost for the current year. Okay? So I went ahead and I added my cost of goods sold, my selling expenses, and my admin expenses. So I'm going to bring those numbers from over here. And here, like your cost of goods sold, they're putting it in parentheses. Your total expenses, they're putting it in parentheses. In everywhere I've worked, we don't use parentheses. In the last edition of the book, we didn't use parentheses. I don't know why they're doing that now. But for my purposes of teaching, I'm not going to put these numbers in parentheses. Their costs, they're going to be positive, okay? Okay. So my cost of goods sold is 100,000. My selling expenses is 16 million. And my admin expenses are 12 million. Now the first thing that we're calculating is variable cost. So we're going to look at these components right here. Variable. Okay. I'm going to transfer that over. 70%. Okay. 75%. And 50%. So now what we need to do is we need to multiply your cost times your variable cost percentage to get your variable cost for each of those categories and then a total. Okay. So because I'm using Excel, I'm just going to get my total cost times my variable cost percentage, and that gives me 70 million. I'm going to get my 16 million times my 75%. That gives me 12 million. And then I've got my 12 million times my 50%. That gives me 6 million. So therefore, my total variable cost is the sum of those three. And that gives me total variable cost of 88 million. We're going to do the same thing, but now we're going to do it for fixed costs. Okay, they're asking us to do the total for variable costs and for fixed costs for the year. Okay, so once again, we're going to pick up the same totals. I've got 100 million. Okay, for my cost of goods sold, for my selling expenses, I have 16 million. And for my admin expenses, I've got 12 million. Okay. We're going to multiply it against our fixed cost percentage right here. Okay. So we're going to do 30%. 25 and 50. Cost times the fixed cost percentage, and then we can get our fixed cost. So you multiply the total cost times the fixed cost percentage, and that gives me 30 million. We're going to get the 16 million times the 25%. That's going to give me 4 million. And then I have 12 million, and I want to multiply that by 50%, and that gives me 6 million. Okay, so now we can add our total, and in this case it's my total fixed cost. Okay. So we're going to add those together. And that gives me 40 million. Okay, that is requirement 2. Okay, it's fairly easy. You just get your categories, which is cost of goods sold, selling, and admin, and multiply it by the rates provided. Okay, so that was number 1. Okay. Number 2, determine the unit variable cost and the unit contribution margin for the current year. Okay, so we're going to start off by getting our sales amount, and my sales was 188 million. Okay, now my variable cost is coming in from there. Okay, $88 million. So now my contribution margin is your sales minus your variable cost. So we subtract our sales minus our variable cost, and that gives me 100 million. Okay. Now, we need to get the number of units. Okay. It says here that we're selling 1 million units. Okay, that's my number of units, 1 million. Okay. Now, I'm going to go ahead and I'm going to divide my amount by the number of units. And that gives me $188 per unit for my sales. You have variable costs of $88 per unit. So your contribution margin is going to be the difference. Okay, so it will be the 188 minus the 88. That gives me $100 per unit. Okay, so number 2, determine the unit variable cost and the unit contribution margin for the current year. Okay, so the unit variable cost per unit is 188 and 88. The contribution margin for the current year is $100. Okay. Okay. Number 3, compute the break-even sales in units for the current year. Okay. Compute the break-even sales for the current year. Okay. So to do that, to calculate my break-even sales in units, I'm going to get my fixed cost divided by my unit contribution margin. Okay. My fixed cost, which one are we doing? Number 3. Okay. So your fixed cost right here That is your fixed cost. You had 40 million in fixed cost. Okay. And I'm going to divide by my unit contribution margin. And your unit contribution margin, we've calculated it, it's right there. It's 100. Okay. So my unit contribution margin is right there, $100 per unit. So let's see, which one are we doing? Okay, so it's a divide, okay. I should have done these. Let me just copy it here in the bottom. Okay. Okay. So now, what is that going to give me? Okay. 40, 1, 2, 3, 4, 5, 6 divided by 100. That gives me 400,000 units. Okay. So to break even in units, I need 400,000 units. Okay. That is requirement 3. My break-even sales is your fixed cost, which is 40 million, and that was provided to you. Your fixed cost, we calculated it right here. 40 million. Let me do a little arrow. Okay, my fixed cost right there. Okay, so that is what we have. So my fixed cost over my unit contribution margin. So to break even, I need to sell 400,000 units. Number 4, compute the break-even sales units under the proposed program for the following year. Okay, compute the break-even sales units under the proposed program for the following year. So what does this say about the proposed program? Okay, management is considering a planned expansion program for the following year that will permit an increase of 11,280,000 in yearly sales. The expansion will also increase my fixed cost by $5 million, but will not affect the relationship between the sales and the variable costs. Okay. So number 4, compute the break-even sales units under the proposed program. Okay. So for number 4, okay, my fixed cost, we calculated fixed cost of $40 million right here. Fixed cost 40 million. And I'm going to divide by my unit contribution margin. Okay. And my unit contribution margin, we had calculated it right there. Where did it go? There we go. Okay. Okay. So your contribution margin, we had already calculated it. So it's your fixed cost of 40 million divided by your unit contribution margin, and that gives you your break-even sales in units. Okay. Number 4. Or what did I do? Let me see. I was typing in the wrong section. No, I'm good. Okay. So my fixed costs were 40 million. Okay, what did I do? Was I typing on the wrong one? 40 million divided, okay. Okay, so now under the number 4, it's under the new proposed program. Okay, so we have a little change here. My fixed costs were 40 million, okay, but the proposal said, what's going to happen to my fixed cost? The expansion will increase fixed costs by $5 million. Okay, so we need to add those $5 million right there. Okay. Let me just put some commas here. There we go. Okay. And then I'm going to divide by my unit contribution margin. And my unit contribution margin is 100 per unit. Okay. Now we can calculate. So I've got 40 million. Well, let me not calculate yet. Let me do another line item. Okay. So 40 million plus 5 million. This 5 million is the extra that's going to be an increase on the fixed cost by 5 million for the expansion. So that'll be 45 million. And I'm going to divide by my contribution margin, my unit contribution margin rate, okay, of 100. Okay. So now I can get my calculator. 45 million divided by 100. That gives me 450,000 units. Okay. Where did it go? Okay. So 45 million divided by 100. That gives me, how much was it? Let me see. 45, 1, 2, 3, 4, 5, 6 divided by 100. That gives me 450,000 units. Let me just highlight this. So that'll be 450,000 units. So that is my break-even sales in units. Okay. Assuming that your, what did it say in the instructions? Let me see. Where did I read it? Okay, the only thing that changed was the expansion increased by 5 million. And sales is going to increase by 11,280,000. Okay, so that is requirement 4. Requirement 5. Determine the amount of sales in units that will be necessary under the proposed program to realize a $60 million of operating income that was earned in the current year. Okay. So we're going to get our fixed cost plus our target profit divided by our unit contribution margin to get our sales units. Okay. So we're going to start off with our fixed cost. Our fixed cost, we had calculated them to be $40 million. Fixed cost, 40 million right there. Okay. So that would be 40 million. Okay. Plus my target profit. What is my target profit for number 5? We want to make 60 million. Okay. And I'm going to divide by the unit contribution margin, which we had already calculated over here of $100. Okay. And let's see what we get. So 40 million plus 60 million. Okay. 40, 1, 2, 3, 4, 5, 6 plus 60. That gives me $100 million. Okay. $100 million. And then I'm going to divide that 100 million by my unit contribution margin. Okay. And my unit contribution margin is my 100 right there. Okay. Now we can calculate our sales units. Okay. Okay, so did I finish this one? No, I didn't. I don't know what I'm doing now, guys. So it's 100 million. 1, 2, 3, 4, 5, 6 divided by 100. That's $1,000,000. What am I doing here? Number 5. Okay, so 40 million plus 60 million, that's 100 million. And then we're going to divide. I forgot to put the minus sign, the underline here. Okay. So my fixed cost plus my target profit divided by my unit contribution margin. Okay, and let's see what we get. 100, 1, 2, 3, 4, 5, 6 divided by 100. We get 1,000,000 units. Okay, let me merge here. Okay, so for number 5, what are they asking? Determine the amount of sales units that will be necessary in the proposed program, realizing a 60 million of operating income that was earned in the current year. Okay, so we get our fixed cost, which were 40 million, plus our target profit. Our target profit provided was $60 million. Okay, and then the unit contribution margin, we had calculated it at 100. So you just do the math, and that will give you 1,000,000 units. Okay. So this problem is long. It has a lot of requirements. You get this top part wrong where we calculate our contribution margin, our fixed cost, and our variable cost, then a lot of the rest of the work will also be incorrect. So we need to make sure that we're doing it right. Okay. We're almost done with the problem, guys. Okay. Now we're in requirement 6. Okay. Determine the maximum operating income possible with the expanded plant. Okay. So according to the problem, our sales, we had in sales 188 million. Okay. And then I'm going to add, because it says here on number 6, okay, determine the maximum operating income possible with the expanded plan. So if we get the expanded plant, then we are anticipating that our yearly sales is going to increase by 11,280,000. Okay. Okay. So let's get our calculator out. Oh, sorry. Over here. Where did it go? Okay. My calculator. Okay, so my calculator for my sales, I had 188, 1, 2, 3, 4, 5, 6, plus the expansion will give you an additional sales of 11,280,000. That gives me 199,280. Okay. Okay. Then we're going to get our fixed costs. How much do we have in fixed cost? Well, we said we had 40 million in fixed costs in the first scenario, but then it said that my fixed costs are going to increase by 5. So I've got 40 million plus the 5 million increase that we show here. Okay? So my fixed cost, it'll be the 40 million plus the 5 million extra due to the expansion. Okay. That will give me 45 million. Okay. $45 million. Let me just put some commas. There we go. Okay. Now to calculate your variable cost, we're going to get, let me do a little asterisk here so we can know how we're calculating it. Okay. So your variable cost is going to be your increase in sales. Okay. So it says here that my increase in sales are 11,280,000. Okay. And I'm going to divide it by my unit price of 188. So each unit is valued at 188. Okay. Oh my God, my computer. Here we go. Okay. And then I'm going to add my sales unit, which was 1,000,000. Okay. Okay. And let's see what that gives us. 11,280,000, 123 divided by 188. That gives me 60,000 plus 1,000,000. Okay, that gives me 1,060,000. Okay. A million 060. Okay. So my variable cost, we now know my variable cost, which is 1,060,000. Okay. Now that I know that, I'm going to get my variable cost of 1,060,000. Times, okay, my units, my variable cost per unit, which was calculated over here, the 88. The variable cost per unit is 88 because we are calculating variable cost. So for every unit, it'll be $88. So my variable cost is going to be 1,060,000 times 88. And that will give me 93,280,000. Okay. Okay. So now we can add our fixed and variable cost. Okay. So I'm going to add my 45 million plus my 93,280,000, and that gives me 138,280,000. That is the total of my fixed and variable cost. Now that I know that, I can calculate my operating income, and your operating income is your sales minus the total fixed and variable cost, and that gives you $61 million of operating income. Okay. So remember, scenario number 6, it's asking you to determine the maximum operating income with the expanded plan. So with the expanded plan, we're having more sales, we're having more fixed costs, okay? And our variable cost is impacted by the increase in our sales, okay? So my operating income, 61 million. There we are. Okay. Number 7. If the proposal is accepted and the sales remain the same What does it say? If the proposal is accepted and sales remain the same at the current level, what will the operating income or loss be for the following year? So they're asking us to do the expansion, but we still only sold at the current level. We didn't sell what we had anticipated selling. Okay. So my present operating income. Okay. Your present operating income. Your present operating income is right there. Okay, right here. We have $60 million in our present operating income. 60. Okay. Well, what's happening if we go with the proposal? Well, what was going to happen? Well, if we went with the proposal, we were anticipating our sales increasing, but our fixed costs were also going to go up by $5 million. So what's going to happen? I have additional cost of $5. $5 million. Okay. So it's present operating income less the additional fixed costs. And then we can calculate our operating income of $55 million. Okay. So number 7 says, if the proposal is accepted and sales remain at the current level, what will the operating income or loss be for the following year? Okay. So instead of having operating income of 60 million, we're going to have operating income of 5 million because of that additional 5 million that was spent on those increase in fixed cost for the year. Okay. Now number 8 says, based on the data given, would you recommend accepting the proposal? So this is where you have to analyze. Should we accept it or should we not? Okay. So according to this information that's being presented, there's a variety of explanations that can be done. I believe in Cengage you're going to have like multiple choice, but I'm going to give you just an overview. Let me just... excuse me, my allergies are killing me. Let me see. Okay, Margin Center. Here we go. Okay. In favor of the proposal is the possibility, and it's a possibility, we don't know if it's going to happen or not, of increasing operating income from 60 million to 61 million. I forgot 3 zeros. From 60 million to 61 million. Okay. And that was calculated. We would go from operating income from 60 million that was given over here to my operating income of 61 million in case we said our sales increased by what we said it was going to increase. Okay. Okay. However, okay, let me grab the text. Okay. However, okay, there are many points against this proposal, such as, okay, the break-even point increase by 50,000 units. I put a little letter A. Break-even point increases by 50,000 units. Okay, so we go compare. Okay, if we stay with the production that we have right now, or the sales that we have right now, and the fixed cost that we have right now. To break even, we would break even at 400,000 units. If we were to go with the proposal, we would be breaking even in 450,000 units. That's the difference of $50,000, 50,000 units that I'm explaining here. So your break-even point is going to increase by an additional 50,000 units. Okay. If future sales remain the same, assuming that, you know what, our sales do not increase, remain the same at the current level, the operating income of 60 million will decline to 55 million. So if our sales do not go up, our operating income of 60 million is going to go to 55 million. So we're going to lose money. Okay. And there's other things that you should analyze before making the decision. The company should determine the sales potential. Okay. One thing it's saying, yeah, we're going to sell more. The other thing is the market is the market good enough to be able to increase our sales? The company should determine the sales potential if the additional product is produced, and then evaluate the advantages and the disadvantages. So you have to really be very confident, disadvantages, that you are able to increase your sales. If you cannot increase your sales, then what's increasing is your fixed expenses, your fixed cost, and then that's going to cause you to lose money. Okay, you're producing the same amount but with higher cost. Okay, so these are all of the calculations for 1 through 7. Okay, so you can be able to first analyze the current state that we're in, and then analyze if we accept the proposal. Okay, so these are all of the formulas, the calculations that are done. It's a long problem. You are going to see something similar to this on your test. So make sure that you master it, that you have everything down, that you know all of the formulas. Remember, your tests are open book, open notes, but not because they're open book, open notes doesn't mean that you don't have to study. You have to prepare. You have to review the specific problems outlined in your review so you can be able to be prepared and pass your test. Okay? So this is basically the conclusion of the lecture over Chapter 20. If you have any questions, please do not hesitate to reach out to me. Thank you.